All right. When it comes to the balance sheet, there can be additional information such as supplemental information. Examples include events that are material, which have uncertain outcomes. Again, this is the lawsuit example. That's just the best example of that, right? Or maybe the warehouse burns down and you don't really know what the damage is yet, but you're going to still mention it because it's important. It could really have a serious implication on your balance sheet. What about accounting policy explanations? This, like I say here, it's going to be elaborated more in the notes of the financial statement section. This is going to be, how do we value our inventory? Do we use LIFO and FIFO or weighted average? How do we value our investments? Just different policies, because every company's different, right? Maybe one company's going to consider gold as a cash equivalent, but another company will not. That is going to be elaborated on there. And then bank covenant restrictions. This is important. So bank covenant, I'm going to talk about this a little bit. You'll see this in BEC as well as FAR. This is going to be, okay, we have a loan with the bank, and the bank says you need to maintain a debt to equity ratio or a asset ratio or something like that of a certain percent, meaning they don't want you to take on too much debt in addition to the debt you have with them. Similarly, if you go to buy a house, I'll put it in terms for you. A bank might say, with your mortgage, personally in your own life, they might say, we don't want you to have too much debt, so you need to have, 2 assets for every 1 liability, and you can't breach that. If you breach the covenant, a covenant's an agreement. And here, if we're saying, let's say the bank is telling you that you need to have 3 assets for every 2 liabilities, right? Now, like obviously that could be $3,000 in assets for every 2,000 liabilities. So what is that ratio? Well, that is going to be 1.5, right? Because, well, that's just 3 divided by 2. That's 1.5. So you have an assets to liability ratio of 1.5. Now, you can go higher than that, sure. So if we have 4 assets for every 2 liabilities, that's going to give us a ratio of 2, right? But if we go 2 for 2, right? If we have 2 assets for every 2 liabilities, well, that's going to give us a ratio of 1. And as such, you would be lower than what the bank's wanting you to have, and you would breach this debt covenant, which is not good, right? We want to keep that. We want to keep our loan. We want to keep our mortgage and not upset the bank.